All right, let's get right into it. We're constantly hearing these stories, right? The stock market's hitting record highs, economic growth is strong, but for so many of us, that just doesn't feel real. It doesn't match what's happening in our own lives with our bank accounts or our grocery bills. This is all about that disconnect, that massive growing gap at the very heart of our economy.
I mean, this is the question, isn't it? You see the headlines, you hear the news about booming markets, and then you try to buy a house or even just fill up your tank, and it feels like you're falling behind. How can both of these things be true at the exact same time? Well, it turns out there's a powerful way to understand this whole situation. Welcome to what economists are calling the K-shaped economy. Just picture the letter K. After a big shock to the system, the economy doesn't just recover, it splits. For one group of people, life gets a whole lot better. That's the upper arm of the K, shooting straight up. But for pretty much everyone else, things get tougher. Their financial reality starts sloping downwards. It's like we're living in two totally different economies at the same time in the same country. So let's start by taking a walk up that upper branch of the K. For the folks on this path, things aren't just good, they are historically good. Just look at this number. That is $85 trillion. With a T, that's more than half of the entire nation's wealth, all held by a single generation, the baby boomers. This incredible concentration of assets is a huge reason why those top-line economic numbers look so fantastic. And this isn't some abstract number on a spreadsheet. You can see it playing out in the real world. Big companies, from hotels to luxury brands, are all saying the same thing on their earnings calls. Their high-end customers are driving almost all their profits. The spending at the very top is so strong that it's actually hiding the weakness happening everywhere else.
So how did we get here? Well, it's really a powerful mix of three things. First, you've got a roaring stock market that's just pouring fuel on existing wealth. Then you have skyrocketing home values, which creates trillions in new equity for people who already own property. And to top it all off, the biggest pay raises are going to the highest earners. It's the perfect feedback loop, you know? Wealth just keeps creating more wealth.
But, okay, that's only one arm of the K. What about the other path? Let's look at that lower branch now, because here the picture is completely different. This is not a story of surge in wealth. It's a story of a relentless, brutal cost of living squeeze. Remember that $85 trillion figure for boomers? Okay, now look at this. Millennials and Gen Z, who are the largest part of the workforce today, hold less than $18 trillion in wealth combined. That is less than a quarter of what the boomer generation holds. This isn't just an age gap, it's a massive chasm that affects everything.
And that lack of wealth means there's no safety net, none. Over half of Gen Z and almost half of all millennials don't have enough savings to cover just 3 months of basic expenses. I mean, think about that for a second. When you are living that close to the edge, one bad car repair, one unexpected bill can knock you completely off your feet.
And a huge reason for this struggle is housing. This isn't just a big city problem anymore. It's basically everywhere. For 20 years, in nearly every single corner of the country, the cost of just keeping a roof over your head has grown faster than people's paychecks. That fundamental disconnect makes it almost impossible to save money or get ahead.
So, when you're squeezed like this, what do? You adapt. You have to. We're seeing a huge trade-down effect across the board. People are using more coupons, switching to store brands, and eating out way less. And here's a detail that really hits home. Some people are switching from laundry pods to powder, just so they can ration it out one scoop at a time. It's such a clear sign of just how intense the financial pressure has become.
Okay, so we've seen the what, these two diverging paths, these two different realities. But the bigger, more important question is why? What's actually causing this? What are the deep structural forces that are splitting our economy in two? Because this isn't some short-term thing, it's the result of changes that have been happening for decades.
It really starts right here with something called the Great Decoupling. For a long time, the deal was simple. As workers got more productive, creating more stuff, more value, their paychecks grew right along with it. But then, around the late 1970s, that link just broke. As you can see, productivity kept soaring, but the pay for a typical worker, it's barely moved in comparison. So, where did all that money go?
Well, a huge piece of the puzzle is automation. As new technology, software, and robots take over tasks that people used to do, the slice of the whole economic pie that goes to workers gets smaller. Instead, that value flows up to the people who own the technology and the capital behind it.
The second big driver is the rise of what you could call corporate market power. As industries get more and more concentrated, you end up with just a few superstar firms that dominate everything. This kills competition, which gives those companies more power to set prices for us, the consumers, and keep wages down for their workers. The end result? More of the pie goes to profits and shareholders, and less of it goes to employees.
And, it is absolutely crucial to understand that these big economic forces don't hit everyone the same way. They're layered on top of deep inequalities that already exist. For example, this chart shows the wealth gap between households headed by men and women, a gap that has basically been stuck in place for over 30 years. When you factor in things like race, the gaps are even wider. So when the pie gets re-sliced by these big forces, some groups are starting with a much smaller piece to begin with. So, what does all of this mean for the future? If we keep going down these two separate tracks, what are the consequences going to be for all of us?
The human cost is it's immense. It's that constant daily stress and anxiety that comes with not knowing if you can pay the bills. It's seeing an entire generation put off major life goals, like buying a home or starting a family. Some call this stacked vulnerability, where people on that bottom branch face a shortage not just of money, but of good healthcare, education, and opportunity. And it leads directly to rising poverty and food insecurity, which are now at their highest levels in a decade.
And let's be really clear here. This is not just about financial hardship. This is literally a matter of life and death. The Poor People's Campaign found that long-term poverty is one of the leading causes of death in America, connected to over 800 deaths every single day. The consequences of this disconnect are as serious as it gets.
And so that leaves us with one final crucial question. When we see the wealth on a stock chart going up and up, but the actual health and well-being of millions of people is going down, it really forces us to ask what we mean by success. Which one of these trends is the true indicator of a healthy economy? The rising line on a chart or the well-being of its people?